Ladies and gentlemen, good day and welcome to Bajaj Electrical Limited Q4 and FY2024 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dhruv Jain from Ambit Capital. Thank you, and over to you, sir.
Thank you. Hello everyone, welcome to Bajaj Electrical's 4Q FY24 earnings call. From the management side, today we have with us Mr. Anuj Poddar, Managing Director and Chief Executive Officer, and Mr. E.C. Prasad, Chief Financial Officer of the company. Thank you, and over to you, sir, for your opening remarks.
Thank you, Dhruv. Good afternoon, everyone. This is Anuj Poddar. I would like to start by acknowledging that we would have liked to have had a better quarter than we've ended up having. That said, I'll just call out some of the challenges and some of what's gone well for us. In terms of challenges, our consumer products business has faced the impact of weak demand, particularly in kitchen appliances. So appliances have pulled us down, as well as general trade, we witnessed weakness in demand. I would also say that part of that is due to the fact that our dependence and contribution from rural markets, as well as our dependence on non-premium segments, is much higher than competition. What is working well and continues to work well for us is our growth in alternate channels across all the sub-segments there. We've had double-digit growth. We have seen growth in the fans business, our coolers business, and Murphy Richards also in the last couple of quarters, we've been witnessing growth in our sales there. Our lighting business, I would believe, continues to do well. While we see a certain contraction in the revenues, that's largely because of LED price erosion in consumer lighting, and in the case of professional lighting, the base effect was high. Last year, Q4, we had a high base. That said, to me, overall performance in lighting business is satisfactory, and our margins there are actually continuing to strengthen, and therefore you see the EBIT performance in the lighting business is good. The underlying trends in the lighting business in this quarter have also been good, and therefore we are confident about the year ahead as well. What stands out for us in this quarter is, despite the pressures on the profitability, on cash flow, working capital balance sheet, we've done extremely well. We added cash flow from operations, or rather generated cash flow from operations of about 147 crores in this quarter, demonstrating our intent to maintain a healthy grip on the operational part of the business here. I'll just call out the two main drivers or drags on our CP margin performance. One is the discounting that both competition, industry, and we had to resort to, particularly in a weak demand situation. And this is partly accentuated in our case because, as you know, we've been churning out our product portfolio from phasing out old products into new products. A fair amount of the old products, because they're getting phased out, have been heavily discounted by us. And the second area which we hope to solve as we go forward is logistics, that we've spoken about in the past, that remains a bit of a drag for us. And that will continue to impact our operational performance, but we are working to address that. The last point I'll make, while it's the Q4 numbers, I'll call out that April has turned out much better. We witnessed growth, top-line growth in April, both for our consumer business as well as lighting business. Fingers crossed, but clearly Q1 looks much better than Q4 has been. With that, I'll hand it back to Ambit. Thank you.
You can start the Q&A.
Okay, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Thank you for the opportunity. So my first question is on the consumer product segment. Now, your presentation mentioned growth in fans. Now, assuming at least 60% of your top line in CP comes from fans, yet we saw operating deleverage play out. So firstly, I want to understand if you can tell us the volume growth in premium and non-premium fans, and also the value-wise split between premium and non-premium. Second related question is, were we able to take any price hike? And also if you can, throw a little more light as to how massive channel discounting has been despite pickup in growth, both at industry and Bajaj level. So this is my first question on the CP side.
Sir, we are not able to hear you.
Well, I'm sorry, I was on mute. Natasha, I'll try and answer your question. Let me know if I missed anything out. So firstly, fans for us as Bajaj has not been above 50, or I think you mentioned 60%. Fans for us is in the 40% contribution range. So we remain largely an appliance-driven company. In terms of volume growth, premium, non-premium, both have been in the single digits. That said, our non-premium has grown faster this quarter. So our share of non-premium, which is everything excluding premium, is about 70% because of higher growth in the non-premium for us this quarter. In terms of price increase, like I called out in the opening comments, rather than price increase, I think we've been impacted by a fair amount of discounting in order to, given the demand situation. So we've not had a price increase in Q4, but we've taken a price increase effective 16th May, so that comes into play later this week.
Understood. So my second question is on the pricing side. So your presentation mentioned that there was EBIT margin improvement mainly on the back of gross margin improvement. So on that two questions, first, can you give a split between your consumer and professional lighting? And also if you can quantify, volume growth between the two, and if we were able to take price hikes in the PL. And is that a reason why EBIT margin so has taken place?
So, Natasha, CL is consumer lighting is about 35%, professional lighting is about 65%. We've not had a volume growth in CL, so the decline that you're seeing in revenues pretty much approximates the price erosion, with volumes being relatively flat. In PL, in professional lighting, quite honestly, we don't look at it in volume terms, because given the nature of products and services business, solutions business also, so their volumes don't have a direct bearing.
So, but were there price hikes? I mean, is that applicable in this segment, or how should we read the gross margin improvement?
I'll answer differently. Firstly, if you see an industry commentary also that you've had fair amount of LED price erosion in consumer lighting through all of this year. So there haven't been price hikes, rather than there's been a downward pressure on pricing. That said, my sense is sometime in Q1, as soon as May or June, you should see the price bottom out, because a lot of the price erosion is coming because of DOB technology that is already now stabilized. So I don't see any further price erosion because of that. So prices should flatten out, and going forward, volumes of normal growth should come back into consumer lighting also, both for us and for industry.
Understood. Sir, I have a couple of more questions. I'll get back in the queue. Thank you.
Sure. Thank you.
Thank you. Next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead. We have been disconnected from Mr. Gajare. Next question is from the line of Praveen Shahai from PL India. Please go ahead.
Yeah, thank you for taking my question. Sir, my question is related to the consumer product segment. As you have mentioned that the fan and the motor resort has given a growth. Can you give some more color on the fan growth? How is that? Single digit, double digit of growth? How you had a feel? I can understand that 70% contribution is a non-premium, but how is the growth part in both the segments?
So Praveen, your voice is not very clear, but I'll answer what I heard. So our growth for fans for us has been in the single digits, both in premium and the non-premium segment. Mind the only part I will add is that we've had some more launches towards the absolute end of the quarter. So some of that pickup is happening. It happened in the last 15 days of March, but also now happening in April. The one example I'll mention there is a small motor BLDC fan. That is a segment we were absent in, That is something we launched towards the end of the quarter, and we continue to do well in April. So I'm confident that our growth in fans during this year will pick up further.
And there is no price hike so far.
So price hikes now are coming into force from 16th May. So we rolled that out in the announcement and from 16th May.
And how is the market research growth?
Morphe Richards is high single digits. I think it's the second or third quarter in a row that we are back to growth in Morphe Richards. And that is happening both on, volume, but also expansion of portfolio in Morphe Richards.
Lastly, sir, can you give the A&P spend for a quarter and a year?
3%. Both the year and the quarter is 3%. Yeah.
Thank you, sir. I'll come in.
Thank you.
Thank you. Next question is from the line of Anirudh Agarwal from Value Quest Investment Advisors. Please go ahead.
Yeah, thanks for the opportunity. Anuj, the first question was on the appliances business, right? So appliances for us continues to be fairly weak. Obviously, the industry context is what it is. But you mentioned that April you have seen growth in the consumer business. Is that are we also seeing some sort of revival in appliances now on this base? Or is it largely still led by fans?
So I think the appliances to call out, it's kitchen appliances that has been dragging us down through last year as well as in Q4. In fact, coolers grew in Q4 also. Coolers by the time of Q1, actually, we pretty much stocked out. That's true for most of the leading top 4 brands in coolers that stocked out. That's a level of demand. We got back some supplies from May, but in general, coolers are on short supply, so that continues to grow. The growth that we're seeing in Q1 is led by fans, coolers to the extent stocks are available, and some, I wouldn't say bounce back in kitchen appliances, but at least the downfall is slightly arrested over there.
Understood.
Sorry, just to add to that, Morphe continues to do well in Q1, April so far also.
Right. Got it. And on gross margins, Anuj, obviously, there is some extent of additional discounting. Any quantification of this? On a normalized basis, assuming that, you would not have to resort to this additional discounting, let's say whenever, overall macros improve from here, what is the sort of gross margins that the business can deliver in that context?
So, Anirudh, I'm a little, apprehensive of giving that number, but I will still give it to you to let you understand the level of, discounting impact that we're facing. It's almost through various means. The discounting is as high as 6%, 5 to 6% across different product categories that is happening. Now, how much of that can be pulled back when? That part I wouldn't want to have a guess. But some of that is what we're pulling back. So the 16th May that we've spoken about is, I think 6% is very high. We are willing to take now relook at how we drive that. I think that is hurting our margin. And I'm not sure the demand elasticity is that high in this. We will take a bet that we will take a price hike and in fact hopefully not have an adverse volume impact on that. But not all of the 6% can be rolled back right now.
Right. And this 6% would be largely primary or a mix of primary and secondary? How would that be?
So for me, firstly, it's direct impact to me. So 6% is impact on me. But the way that those discounts are seen, the structure, some of it is contingent on secondary sales or secondary volumes. But I'm talking about impact on us. So therefore, financially, it's the full impact on us.
Got it. Last question from me was on overall expenses, right? So both on employee cost this quarter, we've seen a reduction. So what sort of run rate should we consider for employee cost going ahead? And on the other expenses front, what sort of elasticity do you see on other expenses? This year, despite top line degrowth, other expenses have remained, fairly elevated. But in a scenario where top line starts growing meaningfully, hopefully that is soon, what sort of elasticity would you see on other expenses? How much operating leverage would we get in that case?
So, first in employee costs, you're seeing a little correction this quarter because of true-up of certain provisions. We had higher provisions that we trued up a little bit. Also, particularly with the variables and incentives, given the performance, we had an opportunity to look at that. That said, I think you have a Q4 figure this year and Q4 figure of last year in employee costs in the investor deck. I think from a future extrapolation, it will be somewhere between these two figures. Okay, we will remain optimal on employee cost. our annual salary hike comes into play in July, that's when you'll see a normalized inflation impact on employee costs. But we are coming to focus with our digitalization, etc., remaining a lean company, lean team. On other expenses, I think both ways we are kind of fixed. So this is the level of other expenses that we think we would operate at, which means as our volumes or value of sales grows, that should translate to operating leverage for us. We don't see other expenses going up in the variable sense.
Got it. Perfect. Final question, Anuj. So, versus the plan that you had laid out, some time back, any structural changes or anything that you would want to revisit as part of that plan?
I don't know what you're alluding to, but 2 or 3 things that I see that should add to delta to us. Consumer lighting is where I think we are very early stages. I'm confident that this year we will see good growth in consumer lighting. Number 2, logistics remains something I will accept that we've not improved fast enough. I wanted to see improvement by now in logistics costs. I think we may be a few months away from that. Just recently, given this, we reviewed. We may bring in some other external consulting intervention logistics because we want to see improvement in that much faster. I think there's at least 2 to 2.5% sitting just in logistics. So to me, the 3 levers of performance that should drive improvement in the coming year, one is consumer lighting. Secondly, logistics once we start getting that right. And third is operating leverage in the consumer products business itself. The operating leverage I would include reversal of some of this discounting.
Understood. Perfect. Thanks a lot and all the best.
Thank you.
Thank you. Next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, hi Anuj. Sorry, I got disconnected last time. Hello?
Hi Rahul, please go ahead. Yes.
Yeah, hi. So, there is always a strategy where one would either go for growth or one would go for margin. You did indicate that 40% of your business approximately is about fans. So how much is the growth that you've done in the fans business in this particular quarter? Can you spell that out?
So in terms of growth, we've grown in single digits in fans. And like I said, it's about 40+% is the contribution of fans to our total revenues in CP.
Okay.
I don't know because some of our fan launches were slightly delayed, so it's come in March. So we've seen the benefit continue into April also. Like an example we've shown in the deck also, a small motor BLDC fan, etc. So as this has been part of the narrative we've had, as Bajaj continues to upgrade or fill in the white spaces in our fans portfolio, including the premium fans, BLDC, now the small motor, decorative fans, etc. That is continuing to add, and we'll continue to see growth in that. The second piece I'll call out there, we've got some reference to the Next. Next, we continue to launch new fans. We continue to see pick up in the run rate of Next. We've got more expansion happening in terms of offline stores to go. We start seeing visibility of Next fans in the stores, offline trade also. We've got more direct dealers and distributors appointed for Next. And you should see a pickup this year also for online sales of Next. So I think between Next fans overall and Bajaj premium fans, FY25 should see faster growth for us.
Okay. So, if you were to choose between growth and margin, which direction are you likely to go for? Because in this particular quarter, we've seen, in fact, even through the year, that we've actually got hurt on both growth and margin. Because, if there is a lot of discounting, typically, at least the growth number should have been much higher than what it has come through.
So I agree with you, Rahul. That's a fair question. I think, we didn't try to choose one or the other. Hindsight, it looks like, this is how it's transpired. If you just, and one thing we track is we've got a 2-year graph on our margins and decline margins. Well, everybody's dropped margins. I think if it not just, don't take it at a quarter level, but if you look at an annualized basis, our margin decline has been slightly better than some of competition. That said, I think we've been, this discounting has not helped us adequately in terms of growth. So now we're really looking at that, which is why I'm calling out this price hike from 16th May. We will now try and see if we take a price hike, maybe we won't see a adverse impact on volume. So that's the current thinking. We will try and flip it around the other way.
Okay, now that one of the reasons for lower profitability has been new product launches. So are we done broadly with all the product launches that we had to, or there is still more gaps to be filled?
No, there's a lot more. So I would say the next 2 years will continue to see. We've always said that. Right now we're seeing enough. You're starting to see all the new products that we've spoken about, but it's not a one-time exercise. It's a 2-3 exercise. We'll continue to see that over the next 2 years. I don't think that does not mean it will be adverse for the next 2 years. That simply means as we get to a tipping point over the next 12, 18 months, our pricing power will improve. So right now we are only seeing the cost side of that, but not seeing the gains of that. So over the next 12, 18 months, we should start seeing the gains of that in terms of us being able to price ourselves upwards.
Okay. I think that's pretty much that I have got. Thank you very much and all the very best.
Thank you, Rahul.
Thank you. Next question is from the line of Manoj Kori from Equirus Capital. Please go ahead.
Yeah, thanks for the opportunity. My question is, if you look at over last 3-4 years, we have been taking many initiatives, and probably we have revisited some of the strategies like product launches, logistic. We revisited the Morphe research. So probably where are we placed? How long will it take to probably finalize strategies on most of the categories, and when should we expect to see some benefit? If any color, probably it would be very difficult to give a specific number, but any color that would be helpful.
So Manoj, good question. I will put it this way. I think strategically we are very much not just on plan, but doing well. So operationally or execution-wise, that we're not fully on pace with what we wanted. We may say strategically or in terms of the brand architecture, how the brands that we spoke about, new product launches, and the features of the new products that we've been showcasing, as well as with design. If you go out, do channel checks, etc., you will hear positive feedback on that. So I think that is important. For us, where that is coming through in a measurable way, though we don't publish that, is brand scores. Our brand is significantly improved over the last 2-3 years across product categories and across the brands that we have. Similarly, on quality metrics, we've seen significant improvement. And when I say this, it's all measurable metrics that we are tracking on quality. So in terms of product, new product launches, product and brand, strategically, we are doing well. On Morphe Richards, it's taken us some time, but the last 2-3 quarters, we're starting to see the traction on Morphe Richards also, both in terms of category expansion and revenue growth. Operationally or execution-wise, where I'm saying we've been slightly weaker and not delivered to what we aspired for, has been particularly aspects around logistics, and logistics come inventory and making sure the right product is available in the right part of the geography. I think that is where we've been behind the curve. I won't go back into history of the Mahindra logistics experience, and subsequent to that, when we've taken it in-house last year, we have not managed to improvise it the way we wanted. That said, like I said in the opening comments, we are revisiting that. We might bring in an external intervention of a consultant to get that right this year if we've not managed to get that right on its own. So that to me remains the one point which we need to solve for and redress, because I think not just logistics as a cost, but its impact on sales boost is also to us very important.
Right, sir. So secondly, if you look at from March onwards, we have started seeing some positive growth momentum. So is it broad-based, rural versus urban, premium versus non-premium, or probably any light on that?
So I'll just call it out saying, we've seen growth in April, I've told you. It's after many months that we've seen sales growth. In fact, it's at the very early double digits growth. But I don't want to extrapolate that for the full quarter, but the fact that even in the month we've got a double-digit growth, that's positive news from our perspective. Given our contribution and mix from rural, etc., while we've not cut that because there's always a margin of error in that, but it has happened because it's both across rural as well as urban and across therefore price points here. So I'll just leave it at that right now.
Right, sir. The last question on kitchen appliances. Obviously, we have gone through a very tough times at the industry level over the last few quarters. Do you see things probably have bottomed out? Probably further decline should not be visible for the industry and for Bajaj in specific?
I would put it this way, Manoj, that if I had to pick between kitchen appliances, fans, coolers, even water heaters for coming segments, I would think fans, coolers, water heaters will be my growth drivers more than kitchen appliances will be, at least for the next couple of quarters. That said, this festive is what I'm banking on. Kitchen appliances have been subdued for a while, So by festive, hopefully, kitchen appliances should also come up and pick up pace.
Got it, sir. Thanks. Wish you all the best, sir.
Thank you, Manoj.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Yeah, thank you for the opportunity again. So my question is, you've mentioned in your PPT that GT channel grew by 3% versus all other channels grew by strong double digits. And yet we saw a top line compress of 8%. Now, can you tell me what is the revenue contribution from different channels, and also what is the rural versus urban mix?
So Natasha, firstly, you're right in the math. So that's why the 3% others are double digits. The reason it doesn't add up to it is because at channel level we track and get gross sales data. The overall we're reporting from accounting at net sales. So that's why it causes a certain discrepancy. Number two, in terms of contribution, so GT is at about 62%, which means the balance adds up to about 38%. Yeah. And in terms of rural urban, that part we don't publish here.
Understood. Thank you.
Thank you.
A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Manoj Gori from Equirus Capital. Please go ahead.
So one question which I missed, probably on the EPA side, like any cost that we recognized during the quarter, and probably how should we look at in the coming years? Probably what should be the calculation, and probably as a percentage of sales or probably as a percentage of volumes, how should we look at?
Yeah, cost for the current year was about 9 crores, and we expect it to be about 12 crores next year.
And sir, some of the competitors have also highlighted like that would be passed on. So should it be assumed that industry would be passing it on, especially when you look at the price hikes have been very difficult?
So my view on that, Manoj, is, you pass on or not is on a holistic basis, not a line-wise thing. I do think as an industry we are guilty of not having passed on overall costs, whether it was star rating impact on fans or overall commodity impact or the CPR. Cumulatively, we've not passed on adequately to the market. I believe that's a defensive strategy we should have. And, in our individual case, we prefer to pass it on, but have to match competition. But now we've taken a call, at least like I said from me, we will now take a reverse situation and try and pass on more costs there.
Thank you, sir.
Thank you. Next question is from the line of Hardik Rawat from IIFL Securities. Please go ahead.
Thanks for the opportunity. My questions are broadly answered. Just wanted to understand one thing. You've mentioned that the board has approved a proposal to raise up to 500 crores through NCDs. Just wanted to understand what this raise would be for.
So that's an enabling resolution that we have taken, so that if some opportunities comes up for an inorganic sort of a deal, then we have the money in place. So nothing planned as of now, but that's just an enabling resolution.
All right. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Amit Kumar, Undetermined Investment. Please go ahead.
Yeah, thank you so much. I think one question. I'm just sort of trying to reconcile, the broad macro data with, what is happening in the industry. Right. So last year we had almost, in fact, even better than expected. So expectation was 6-7%. We're definitely ending up with 7% plus, actually closer to 7.5% kind of GDP growth. Right. This is a category which is still not. Whether it is kitchen appliances or other appliances, so to speak. It's a category which is not sort of fully penetrated. There's so much of opportunity in rural areas and bottom of the pyramid population as well. And then we are looking at a situation where at the industry level, growth has been so disappointing last year. So we've seen that in a few other consumer categories also, FMCG, etc., at the beginning of the year. But in the fag end of the year, FMCG seems to have recovered. So in sense, what is really going on? I mean, there is obviously then that unorganized to organized shift opportunity also available. Smaller regional brands sort of shifting to a Bajaj or some of the other brands, and then premiumization. This is the whole of last year has been pretty disappointing from a macro perspective and from a demand perspective itself, especially in light of the kind of GDP growth numbers that we are seeing basically. So could you just, do you have any thoughts on what is going on really here?
So Amit, this is a question better for some economists. We are lay people here. That said, I'll give you a certain couple of pointers or hints to where to look at this. If you look at the Q3 GDP data, it is about 8%, if I remember correct, 8.2 something. But the private expenditure growth, consumption expenditure growth in that is about 3%. So a delta of almost 5% was a historical high delta between GDP growth and private consumption expenditure, which is not usually. You probably have a couple of percentage points gap between these two. So what that also shows is a lot of the GDP currently is being driven by infra or capex rather than actual consumer expenditure and consumption. That's point one. Point two, reasons for this. Or before that, to your point on, it seems to be a broad trend across consumption sectors, not just our sector, but also FMCG. I can agree with you. In that, while you said Q4 FMCG's shown growth, I think it's very early stages, not being very strong growth. I won't call out individual company names, but there is some positive commentary on that in FMCG, including a couple of weeks ago what Nielsen mentioned. Maybe Q1 we will see some growth in FMCG, including rural bounce back as well. Now, I would be very happy to see that because I think us as FMEG or FMCD typically have a lag of 1 to 2 quarters from FMCD. So once that happens, we would hopefully follow suit on that. And only the third point that I would point you towards is keep watching interest rates and inflation. As that cools off, particularly interest rates cools off, I think that should be a big trigger for consumption expenditure to come back. I think that's something holding people back right now. And sorry, just one fourth point I'll slip in is the government, I would like to believe, is cognizant of this. There's enough chatter. There was some chatter around this year's vote on account in Fed, but since that is just a vote of account, maybe in the July budget, they will take some planned intervention to boost consumer sentiment. I think there are easy ways and means to do that without impacting fiscal deficit.
Okay. But there is no sort of specific driver for this segment, which is the appliances and durable sort of segment, which is sort of keeping things so muted. Nothing that
no, nothing negative to the segment. I think it's a proxy or marker of overall consumption, sentiment right now, and I do remain bullish that will turn down. And for whatever it's worth, like I told in April, we've seen growth. Maybe part of that is with a good monsoon outlook. Maybe demand that's been subdued for a while. At some point, low base effect will kick in. So statistically, many of these things will play out. But directionally, I think we should not be too far out from consumption expenditure coming back into play in one form or the other. Just on the other point that I mentioned, that right now GDP is being driven by infra and capex cycles, that also finally has to percolate down to consumption expenditure. That usually has a lag. So if normal case consumption expenditure doesn't pick up, then with the infra capex percolation down to people's hands and spending back, that automatically will also come into play.
Okay. Understood. Thank you. That's it for now.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
I had a question on the capex, right? So we've done about 130 odd crores of capex in FY24. Just wanted to understand what's the kind of direction in terms of capex intensity should we look at it from FY25 and FY26 perspective? Any specific category that you're looking to invest a lot more on from an in-house capability perspective?
Yeah. So Dhruv, most of these capex were looking to the new products that we invested on, especially in form of the tools and molds, etc. And as Anuj mentioned, this would continue for another 2 years, so you can expect a similar sort of a capex levels for the next 2 years.
And just to add to that, Dhruv, one second, in terms of capacity, otherwise, we're not looking at some big bang, large-scale factories, but our capacity across most of our products, our fans, our mixers, water heaters, lighting has continued to increase over these last couple of years. That's through smaller capex interventions that we're continually making.
Okay. And just had a question on the new products, right? So you've been driving this new product initiative for some time now. So if you could just throw some light on, as a percentage of sales, what would be the contribution and any direction that we should think about it? And if you could just say that, if you could just give some data around margins, what could be the kind of margin differential between these two?
So Dhruv, sorry, we don't disclose our contribution from, new product development. That said, obviously, we track it internally. So that has had a steady state growth over the last 2 years. We used to do that as part of our own board meeting also today, but it's not data that we publish here.
Okay. Thanks so much.
Thank you.
Thank you. Next question is from the line of Praveen Sahai from PL India. Please go ahead.
Yeah, thank you for the follow-up. Sir, can you give the capex number for this financial year? And also, as you are explaining about the plant expansion, can you give some color on the in-house manufacturing contribution right now and the way forward?
So the capex spend for the year is 124 crores, and the in-house manufacturing is about 20%.
So 124 crores for FY24.
4, yeah.
And how is the plan for?
Next year will be similar level. It will be in the range of about 150 odd crores. Similar levels.
Okay. And
next year will be similar level.
Okay. And the in-house, as you mentioned, at 20%, is there any material change you are expecting in the coming couple of years?
So I'll give you an indication. The last 2 years has grown from 17 to 19 to 20. I think this year should go up to 22 or 23. So that's the kind of incremental that is going to happen. But what's happening is qualitatively, there's more high-end stuff that's been coming in, and the lower-end commoditizing is been getting pushed out there. And second part I'll add to that, all of this tool molds that we talk about, that capex is not restricted to our plant. So that is where we have greater control over. A lot of that is placed at the third-party manufacturers also.
Okay, because, earlier, if I remember, you had a guided for a 25% or to reach by 25, and that will also improve your some, bit of a margin profile as well. So that's why just a query on the in-house, how this 20% to go forward.
So I'll comment, and I don't remember what exactly you might have heard me say in the past, but I've always said we don't have a target number. That might be where we end up with, but that's not a goal by itself. But the quality of that is important. So what we do in-house and what we do outside, that is important. Secondly, the ROE or ROC is important to us rather than the pure EBIT margin. So to connect what I said earlier also, we are also investing in the quality of manufacturing and our control on the production cycle at third-party manufacturers. So increasingly all the tools, molds, dies, etc. manufacturers also increasingly owned by us. So to us, they're not really, white label services, but our contract manufacturing and our IP, our product, our control over the production and quality over there. So to us, that is how we're looking at manufacturing.
Okay, great, sir. And also, if you can give some numbers on how the distributor count has increased by end of FY24.
Sorry, Praveen, can you repeat? I didn't hear this.
So, distributor count, how is that at the end of FY2023?
It is right now. 749. Yeah.
Okay.
So to give you a hint, last year in March 23 it was 660. This year March 24 we exited at 749.
Right. Thank you, sir.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. As there are no further questions, I would now like to hand the conference over to management for closing comments.
Thank you. No, I'll just thank everyone once again for attending this. I'll reiterate what we said. We've had a mixed quarter. We'd have liked it to have been better. We've had some shortcomings, particularly on the CP business led by appliances and general trade. But at the same time, there are other positives in terms of our lighting business, alternate channels, coolers, and some growth in fans and more features also. April has started off better for us, and we remain positive for the year ahead. Thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.